The purpose of today's video is to go through the suggested solution for Hyatt Limited, which was provided as a classwork question under IAS 40. Hyatt Limited has a 30 September year end. On the 1st of October 2008, Hyatt Limited acquired land and buildings for a fair value of 15 million rand, in total, of which 70% was attributable to the buildings. The property was classified as investment property and is accounted for in terms of the cost model of IAS 40 investment property. On the 1st of October 2008, the useful life of the buildings was estimated to be 20 years, and the estimated current residual value amounted to 1.5 million rand. Depreciation is written off on the straight line method. All estimates were revised annually and no changes were deemed necessary. There was no indication of impairment at the end of any financial year. On 30 September 2011, after the draft financial statements for the current financial year had been prepared, Hyatt Limited decided to change the accounting policy from the cost model to the fair value model in terms of IAS 40 investment property, as Hyatt Limited expects the fair value to more fairly represent the future economic benefits associated with the asset. The following fair values, determined by an independent sworn valuer who holds a recognized and relevant professional qualification and has recent experience in the location and category of the investment property being valued, are applicable to the property in total. On the 30th of September 2009, the building and the investment property has a fair value of 14,800,000. On the 30th of September 2010, it's 14,950,000. And on the 30th of September 2011, it's 15,175,000. Required: disclose the change in accounting policy note of Hyatt Limited for the year ended 30 September 2011 in accordance with IFRS. Note: round all calculated amounts to the nearest 1 rand. Ignore any tax implications, and the accounting policy note is not required. Before you start performing any calculations or drawing up the note, it's important to actually ask yourself, what do they want from us? And if you go and read the required again, the required states that we are required to disclose the change in accounting policy note of Hyatt Limited for the year ended 30 September 2011. Now, when you think about a change in accounting policy note, you need to think about how many columns there are in a change in accounting policy note, because the number of columns in a change in accounting policy note is different to the number of columns in a prior period error note. And in a change in accounting policy note, we know that there are 3 columns, one for the current year, one for the prior year, and one for the opening balance of the prior year. Now that you know exactly what is required of you, you can now go and perform the calculations. So on this slide, you will see that I have a different box for the cost model and the fair value model. Why? Because the investment property was held on the cost model as per IAS 40, but we are now changing it to the fair value model. So we need to compare what has actually happened to what should have happened. So if we first go and look at the cost model, which is what has been done in the books of Hyatt Limited, we know that under the cost model in IAS 40, the investment property will need to be depreciated every year. But now this investment property consists of both land and buildings, and we know that land does not get depreciated because it appreciates. So we need to calculate the annual depreciation on the building. We are given one cost price, or the fair value at acquisition date, of the investment property, which amounted to 15 million rand. And they told us that 70% of this fair value is attributable to the building. Therefore, we need to take the 15 million rand and times it by 70% to get the cost price attributable to the building. From that, we can then go and deduct the residual value, which is attributable to the building, and that was given to us as 1.5 million rand, and we then go and divide it by the total estimated useful life of the building, which amounts to 20 years. If you perform that calculation, you would have got an annual depreciation of 450,000 rand. Now we know that the investment property was purchased on the 1st of October 2008, which is the beginning of a financial year, and therefore you had the investment property for the entire year, so you would have depreciated it for the entire year. So on the 30th of September 2009, your investment property would have had a carrying amount in the books of Hyatt Limited of 14,550,000 Rand. How did I get that? Well, it is the cost of 15 million less the depreciation for the year. We then go 1 year further and we work out the carrying amount on the 30th of September 2010. That is then 14,100,000 Rand. How did I get that? Well, I took the carrying amount at the end of the prior year and I deducted the annual depreciation of 450,000 Rand. That gives me the 14,100,000 Rand. We then need to work out what the carrying amount of this investment property is at the end of the current financial year, which is the year ended 30 September 2011. So I take the carrying amount from the end of last year of 14,100,000 Rand and I deduct the annual depreciation of 450,000 Rand. That then gives me a carrying amount of 13,650,000 Rand. Now, if I go and look at the fair value model, on the fair value model, we know that the investment property does not depreciate every year. Instead, we adjust the carrying amount to fair value at the end of each period, and the fair value must to be determined by an independent sworn appraiser. So we know that at the end of 2009, on the 30th of September 2009, we would have had to account for a fair value adjustment. Why? Because currently the investment property is sitting in our books at its cost of 15 million Rand, but we know that its fair value on the 30th of September 2009 is 14,800,000 Rand. Therefore, we would have written off 200,000 Rand as a fair value adjustment, which would have appeared in other expenses. Why in other expenses? Well, because the fair value of the investment property is decreasing. In 2010, we would have also gone and calculated a fair value adjustment, but now we go and compare the fair value on the 30th of September 2010, which is the 14,950,000, and we deduct from that the fair value from the 30th of September 2009 of 14,800,000 Rand. Why the 14,800,000 Rand and not the 15 million? Well, in our books, the investment property is sitting at a carrying amount of 14,800,000 because we took away 200,000 Rand when we wrote off the fair value adjustment. That then gives me 150,000 Rand as a fair value adjustment. But is this an upward or downward fair value adjustment? The fair value was 14,800,000. The fair value is now 14,950,000. Therefore, the fair value has increased, so we recognize the difference as an income. In 2011, we will once again have a fair value adjustment. So we take the fair value on the 30th of September 2011 of 15,175,000 Rand, and we deduct from that the fair value on the 30th of September 2010 of 14,950,000 Rand. That then gives me a fair value adjustment of 225,000 Rand. Now, once again, you need to ask yourself, is this an income or an expense? So the fair value was 14,950,000. The fair value is now 15,175,000. Therefore, the fair value has increased and we will have an income. If we now look at the effect of the change in accounting policy on the profit figures and from the calculations performed on this slide, we can see that in 2010, we will have a decrease in other expenses. Why? Because in 2010, we would have recognized depreciation, but now we don't want the depreciation to be there, so we have to decrease the other expenses. But we will have an increase in other income, because in 2010, we have a fair value adjustment of 150,000 Rand increase, and therefore it is recognized as an income. In 2011, we will once again have a decrease in other expenses because depreciation was recognized, but we no longer want it to be recognized because change in accounting policies are applied retrospectively, and we will once again have an increase in other income. Why? because in 2011 we had an upward fair value adjustment of 225,000 Rand. Now you will note that in the effect on profit figures block, I do not have an effect on profit figures for the first day of the 2010 financial year, being the 1st of October 2009. The reason for that is on the 1st of October 2009, you are looking at balances. We do not have an other expenses line item on the 1st of October 2009. We do not have an other income line item. All of those amounts that would have been in your other expenses and other income from previous years is now sitting in retained earnings. Therefore, we go and make an adjustment to retained earnings for that very first column relating to the 1st of October 2009. In order to calculate the effect on the investment property line item, which you need to remember is the carrying amount of the investment property at the end of each year, it is important that we now go and compare the carrying amount of investment property as per the fair value model and the carrying amount of investment property as per the cost model. So the fair value model is what the carrying amount should be. The cost model represents what the carrying amount currently is in our books. So if we look at the 2009 financial year, the fair value at the end of 2009 is 14,800,000 Rand. However, on the cost model, we have a carrying amount of 14,550,000. Therefore, in order to get the carrying amount of investment property to be the 14,800,000, we need to increase the carrying amount by 250,000 Rand. If we look at 2010, the fair value model shows that we should have a carrying amount of 14,850,000 Rand, but on the cost model, we are currently sitting with a carrying amount of 14,100,000 Rand. The difference, once again, is an increase that needs to be taken into account, and this increase is 850,000 Rand. Once again, if we do this in 2011, on the fair value model, we should have a carrying amount of 15,175,000 Rand. However, on the cost model, we have a carrying amount of 13,650,000 Rand. Therefore, we need to increase the carrying amount of investment property by 1,525,000 Rand. So when you're working out the increase or the decrease in the asset line item relating to investment property, it is important that you compare the carrying amount as it should be to the carrying amount as it has been taken into account, i.e. your fair value model carrying amount versus your cost model carrying amount. Now that we have performed all of the calculations, we can now go and prepare the note to the financial statement. So remember, whenever you are asked to disclose the notes to the financial statements, it's important that you always start by stating the name of the entity, so in this case, Hyatt Limited, and then you need to state that we are now looking at notes for the year ended and then whatever the year ended is. So in this case, our year end is the 30th of September 2011. Then we are specifically looking at the change in accounting policy note, so you need to give me the heading of the note that you are providing me with. And then remember that as per IAS 8, whenever we have a change in accounting policy, we need to provide the users of the financial statements with a little bit of narrative information explaining when we made the change in accounting policy, why did we make the change in accounting policy, and if we are working on a fair value model versus a cost model, we need to tell our users how were the fair values actually determined. So in this scenario, my narrative information reads as follows. On the 30th of September 2011, Hyatt Limited decided to change the accounting policy for investment property from the cost model to the fair value model in terms of IAS 40 investment property. Hyatt Limited expects the fair value to more fairly represent the future economic benefits. The fair values were determined retrospectively by an independent sworn appraiser with the relevant qualifications. And then I provide the changes in my line items. Now, the information regarding Hyatt Limited expecting the fair value to more represent future economic benefits and the fair values being determined by an independent sworn appraiser, that information is copy and pasted from the information provided to me in the scenario. Alright, so the information that you need to write in this little narrative is given to you. You just need to find it and then write it down. Now, if we look at the table, you can see the three different columns that I was referring to on one of the first few slides. So like I said, we have a column for the current year being 2011. We have a column for the preceding year being 2010. And then we have a column for the opening balance of the 2010 financial year, which is the 1st of October 2009. Now you will see on that 1st of October 2009 column, I have no amounts in the decrease in other expenses, increase in other income, or increase in profit for the year. Why? Because those opening balances are reflected in retained earnings, okay? And it's too long ago to go back and now open up those books in order to make the changes in those line items. So we make the changes into retained earnings, okay? So here you make the changes to the assets liabilities account and then to retained earnings, which is an equity account. So if we look at the column dated the 1st of October 2009, you will see that we have an increase in investment property of 250,000 Rand, and that was explained on the previous slide. But then we also have an increase in assets of 250,000 Rand. Now you need to remember that investment property is an asset, and in the statement of financial position, you have all of your assets listed and then you write there total assets. So you need to show that the increase in investment property will also result in an increase in the total assets. Once again, we then also have an increase in retained earnings of 250,000 Rand. Why? Because in the prior year, in the year prior to the 1st of October 2009, that was the first year that we had the investment property, we would have written off depreciation of 450,000, and we should have recognized a 200,000 Rand fair value adjustment, but as an expense. So we want to decrease the other expenses by 450,000, but then we also want to increase the other expenses by 200,000, representing that fair value adjustment, and therefore we are decreasing the other expenses by more than what we're increasing it by, and therefore we increase retained earnings. Because if we have a net decrease in other expenses, that means we have a higher profit figure. So we have an increase in profit, which leads to an increase in retained earnings. Once again, retained earnings and share capital are added together to give us total equity. Total equity is a line item in our statement of financial position, and therefore we need to show that our equity has increased by 250,000 Rand. We can then move on to the 2010 financial year, and now that is just the prior year. So in the prior year, you can show the effect on your incomes and expenses and your profit. So we have a decrease in other expenses of 450,000 Rand because we no longer want to write off depreciation. We have an increase in other income of 150,000 Rand due to that fair value adjustment, which was explained on a previous slide. And that results in a net increase in profit for the year of 600,000 Rand. How did I get that? Well, if I decrease my other expenses and I increase my other income, you're going to have a big increase in profit because a decrease in expenses results in an increase in profit. We then move on to the increase in investment property. So that increase in investment property in 2010 was calculated on the previous slide as 850,000 Rand. Now you can see, if you go and say the 250,000 Rand increase in investment property on the 1st of October 2009, plus the increase in profit for the year of 600,000 Rand, you get 850,000 Rand. That is how the change in accounting policy note works. All right. Once again, if we have an increase in investment property, we need to show that there's an increase in assets, and then we need to go and show an increase in retained earnings, and then an increase in equity. All right. Now, this increase in retained earnings and the increase in equity is cumulative. So once again, it's the 250,000 increase in equity due to or relating to the 1st of October 2009, plus the 2010 increase in profit of 600,000 Rand. That gives me the 850,000 Rand. We can then move on to 2011. In 2011, we have a decrease in other expenses of 450,000 Rand because we no longer want to recognize the depreciation, so we have to take it away. And a decrease in other expenses results in an increase in profit. We then have an increase in other income because once again we had an upward fair value adjustment, and that results in an increase in profit for the year of 675,000 Rand. We then get an increase in investment property of 1,525,000 Rand. How did I get that? Well, you can calculate it on as seen in the slide before this one, or you can go and take the 850,000 Rand increase in investment property from 2010 and add the increase in profit for the year of 675,000 Rand. That would then give me the 1,525,000 Rand. The same applies to the increase in retained earnings. That is then the change in accounting policy note for Hyatt Limited. I hope this video helped, and if you have any questions, you are welcome to contact us on frk201consult@gmail.com.